You spend 40 years building your wealth. It could take just 3 years of long-term care to cut it in half. With nursing home costs rising nearly 10% in a single year, self-insuring isn't just about having savings. It's about liquidity and leverage. So today, we're going to stress test your portfolio against the reality of next year's prices. Welcome. If we haven't met, I'm Bob Wolfe, certified financial planner and IRS enrolled agent. My promise to you is that by the end of this video, you will have a specific 4-step framework to manage this risk. We aren't just going to talk about buying insurance. We're going to talk about biology, technology, and portfolio structure. We are living through a demographic revolution, but this additional time brings new economic risks. Just look at the recent data. The economy added 73,000 new jobs, and nearly all of them were in healthcare. Despite that hiring, we still have massive shortage of caregivers. This shortage is creating a financial paradox. You might assume that if you just need a little help around the house, cooking, cleaning, laundry, it will be cheap. That assumption is dead. In 2024, the cost of homemaker services rose 10%, while clinical home health aides rose only 3%. Why? 2/3 of agencies now charge the same hourly rate for a companion as they do for a nurse. You are paying premium rates just to keep the household running. Money doesn't solve scarcity. Since 2020, the US has lost nearly 63,000 nursing home beds. Facilities are closing faster than they are opening. This is creating nursing home deserts. This is literally a term that they call it now. Having $2 million in a bank doesn't matter if there's literally no bed available in your zip code. We have to plan not just for the cost of care, but for the access to care. I don't want you to take my word for these averages. Costs vary wildly by zip code. So I want you to go to carescout.com/cost of care, link in the description. This is an interactive tool where you can plug in your location and see exactly what home health aides or facilities cost in your neighborhood right now. It is an eye-opening exercise, and it is the first step in stress testing what expenses we might need from our resources. Now, most people think that the only solution is buying an expensive insurance policy, but that is actually step 3. The first and most effective step is something you can start today, and it costs almost nothing. In finance, we manage risk. The best way to manage the cost of care is to delay the need for it. We call this risk avoidance and reduction. This relies on behavioral and environmental factors. By investing in your health now, we protect your financial portfolio later. The first thing, which is most surprising, is sleep architecture, the brain's cleaning system. New research suggests that sleep continuity is critical for your brain's ability to clean itself. Investing in a sleep environment that ensures 7 to 8 hours of continuous rest, whether it's a better mattress, blackout curtains, or medical treatment for apnea, is a direct preventative measure against expensive memory care later. Next is hearing. Untreated hearing loss is a significant risk factor for cognitive decline and dementia. When you can't hear, your brain has to work overtime to process sound, leaving less energy for memory and thinking. You also tend to withdraw socially, and isolation accelerates decline. With the FDA now approving over-the-counter hearing aids, the cost barrier has dropped. Treating hearing loss isn't vanity, it's asset preservation. Number 3, social circles. We need to ensure that you have a good social network. Living in a community with social density, places to gather, volunteer, and interact keeps the brain pliable. We look at naturally occurring retirement communities where neighbors support neighbors. Investing in your social network is just as critical as investing in your retirement. 4, the smart home and fraud prevention. Finally, we're moving beyond the "I've fallen and I can't get up" button. We now have ambient sensors using radar and Wi-Fi that detect falls through walls without you wearing a pendant. But part of aging in place is also digital safety. Older adults reported losing nearly $1.9 billion to fraud recently, often through tech support scams. Digital security is now also long-term care planning. But even with the best health habits, the risk remains. So we can't avoid the risk entirely. How do we pay for it without going broke? If you have significant assets, you might choose to risk retain or self-fund. But paralysis often sets in because the numbers look so big. To solve this, we use the good, better, best framework to break the problem down. First, the good plan, home care. We calculate the cost of 20 hours of home care a week. We subtract your guaranteed income, Social Security, pension sources, and we fund the gap. This keeps you home. Next, the better plan. This would be assisted living. We look at the cost of a high-quality assisted living facility, often $6,000 to $8,000 a month. We can stress test your portfolio to see if we can sustain that for 3 to 5 years without selling the house immediately. And third, the best plan, full memory care. And this is full installation. This is the 24/7 skilled nursing scenario, $12,000 plus a month. If self-funding this jeopardizes your surviving spouse, this is where we might look for insurance leverage. Next, we can look at tax efficiency and the shoebox strategy. We also maximize tax efficiency if we have health savings account. Here's a pro tip called the shoebox strategy. If you have cash flow now, don't spend your HSA. Consider paying medical bills out of pocket and save the receipts in a digital shoebox. Years later, you can reimburse yourself for decades of expenses prior tax-free to fund a home health aid or in-service facility. It becomes a tax-free longevity war chest. Self-funding works for the wealthy, but for many of us, a $300,000 care event would devastate our lifestyle or our spouses. So in that case, we need to transfer the risk. And this brings us to insurance, but timing is everything. The data shows that there is a sweet spot for considering long-term care insurance products, typically between age 55 and 65. Once you cross age 70, denial rates skyrocket to nearly 47%. If you are in that window right now, do not wait. As it relates to the products, we have traditional and hybrid. The industry loves hybrid policies. These combine life insurance or annuities with long-term care. They're popular because if you don't use it, your heirs get a death benefit or you continue to get an income stream. It solves the use it or lose it fear. However, I do not favor hybrid policies unless you actually have a need for the primary product. Ask yourself, do I need life insurance or an annuity? If you are 65, your kids are grown, and your house is paid off, you might not need life insurance. With a hybrid, you are paying for two things: the risk of passing away or longevity insurance and the risk of long-term care. The alternative we often look at is traditional long-term care if you can tolerate potential premium hikes and the premiums itself. For couples, we often look at shared care riders. In a standard scenario, if a husband runs out of his 3-year benefit, he is out of luck. With shared care, we pool those benefits. If he needs 5 years of care, he can use his 3 years plus her 2 years. This protects the surviving spouse from being left destitute. Now, there is a strategy that combines lifestyle with risk management, and it's called continuing care retirement communities. You move in when you are healthy and independent, but your contract guarantees that if you eventually need assisted living or memory care, you move to that wing on the same campus. It is like a 55-plus community with skilled nursing on premises. This preserves your social circle. You aren't uprooted from your friends. You simply move down the hall. Finally, we must discuss Medicaid. Many middle-class families end up here because they didn't plan, or they are of a means where it cannot be affordable otherwise. But eligibility is strict. First, we have the asset limit. Generally, a single applicant is limited to $2,000 in countable assets. This limit has not changed for decades, though states like New York and California are higher. And then we have the lookback. Medicaid looks back at asset transfers for the last 5 years, so you cannot simply gift money to kids when you get sick. Then we have spousal protections. If you are married, the community spouse is protected. For 2025, you can typically keep around $162,660 in assets if they aren't impoverished by their partner's care. The other thing about continuing care retirement communities, or any care, is that these can be seen partially as a medical expense deduction. So in the year of which we go into a CCRC, or when we incur large major medical expenses, this can help offset and defray the costs if we have larger expenses and income to be offset with a larger deduction. The hardest part about long-term care isn't writing the check, it's managing the risk. If you rely on your adult daughter, you are impacting her career and her own retirement savings. We call this the hidden cost of caring. I strongly recommend we consider a geriatric care manager into our discussions. These are licensed professionals, nurses or social workers, who act as a general contractor for your care. They vet the facilities, manage the home care and health aides, and argue with the insurance company so your family can simply be your family. You don't buy long-term care protection to protect your health. You buy it to protect your portfolio and your family's lifestyle. Whether you need to set up a good, better, best funding plan, shop for a shared care policy while you are in your 55 to 65 age window, or look at CCRC contracts, the only wrong decision is to have no plan. I want to invite you to schedule a longevity stress test, where we can discuss the options that you have ahead of you and look at your current assets and run real costs of care. Let's ensure your plan is as robust as your life. If you found this video helpful, please share it with a friend who might also be going through similar challenges on the horizon. And as always, thanks for watching, and I'll see you in the next video.